Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. So today, our webinar title is Gain Access to Local and Foreign Markets with Structured Warrants. So welcome to this webinar. My name is Shen Chu. I'm the moderator for this session. So do you know that you can actually gain exposure to the foreign markets without leaving the Malaysian shore? So that is how you can, there's one way you can do it is through locally listed structured warrants. So today we're going to learn what are structured warrants and how we can use it to achieve our trading or investment objective. So as usual, disclaimer. So this disclaimer is that please do not download, upload, post, or otherwise make available any material from this webinar to the public without our prior consent. Number two is the presentation material has not been reviewed by Securities Commission Malaysia. So as usual, another disclaimer is that whatever we share on this session is only for educational purpose. In no way that give you any recommendation for you to buy or sell any listed securities mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. So allow me to briefly introduce our speaker today. He is part of one of the locally renowned issuers from Macquarie. All right. So Choong Kum Kie is part of the Macquarie Warrants Malaysia sales team. So aside from conducting educational seminars and workshops on technical analysis and structured warrants, he's also involved in the issuance, sales, and marketing of structured warrants listed on Bursa Malaysia. And he has been involved in the capital markets industry for over 12 years, dealing in equities and derivatives listed on both Bursa Malaysia and foreign exchanges. So today we are very honored and humbled to have a speaker from Macquarie team to speak to us about how do we gain exposure to the local and foreign market using structured warrants. So without further ado, let me invite Kum Kie to this webinar. Hello, Kum Kie.
Hi, Shane, thank you so much for the introduction.
All right, cool. So yes, I'll hand over the session to you, yeah?
Sure. Let me share my screen. Can everyone see it? Okay.
Yes, can see your screen. Perfect.
All right. Okay, so thank you so much again, Shane, and very good evening to everyone here in the session. Before we get started, I just want to give a big thanks to Bursa and LifeChamp for having me tonight. By introduction, my name is Kum Kie, and you can call me KK. And I'm part of the warrant sales team here in Macquarie, Malaysia. And certainly excited to be here tonight to share with you guys on ways that you can gain access to the local and foreign markets via structured warrants. Also, I wish everyone here a job well done. I want to wish them a job well done for taking up your time tonight to attend this session. You know, to learn and make changes into your trading. So it means that you are taking this seriously, and I hope tonight's session will bring good value to you. And I'll try my best to make the session as informative and interesting as possible. All right. So without further ado, let me just kickstart. Oh, okay. As usual, before we get started, I just want to remind everyone that the presentation materials here have not been reviewed by the SC. And also, please don't download or make available the materials of this seminar to the public without consent. And also, what we are going to discuss here today is purely for educational purposes. And whatever information that is quoted here in this webinar is for illustration only. And they don't represent any investment views or strategies or financial advice or any kind. All right, now just a reminder that all investment products, including warrants, are subject to a significant investment risk, and including the possible loss of your capital invested. So I mean, bear in mind that past performance is not indicative of future performance. All right. So okay. I guess this has been covered as well by Shane. So I guess we can just go straight into our first slide for the day. Our topic here. Okay, our first topic would just be a brief introduction about warrants. These are the basic information about warrants. I mean, sort of like what are they? Why people trade them? How to identify or differentiate between different warrants in the market and so on. All right. So, without further ado, let me just go in. Okay. Now, before I start on with this slide, I think most of you have probably heard of the term structured warrants before this, or maybe even traded them previously. Okay, structured warrants, they are actually listed securities or instruments. They are issued by financial institutions like us or other investment banks in Malaysia that allow investors to buy or sell a particular underlying asset at a fixed price within a fixed period of time. Okay, so warrants, they actually allow investors, right, to gain exposure to a certain underlying asset at a fraction of their at a fraction of their price. Okay, and these underlyings usually include both local and foreign stocks. They include indexes as well, and also ETFs, among others. All right, now for many investors, right, warrants, they may seem similar to options, but warrants typically they have a wider variety of exercise prices and expiries compared to options, where the contracts are more standardized and with limited expiry dates and exercise prices. So also warrants, they are issued by financial institutions like the investment banks, while options, they are developed by the exchange. Right now, why are warrants so famous among investors? Right, it comes into four main reasons. In which the first one that I feel is the main driving factor of why many investors and traders are keen in trading structured warrants is the gearing that they provide. Okay, now because warrants, they tend to fluctuate in value at a higher percentage rate than their underlying asset. This makes it one of the main reasons why they are so popular. And I mean, if you compare between an underlying stock or a call warrant, so let's take for example a stock, a mother share that is trading at 1 ringgit, and then the call warrant is trading at 10 cents. Let's say for example, okay, you will notice that if both has risen by 1 cent, the underlying mother share would see a 1% gain, whereas the warrant would have gained by 10%, sorry. So, which means, right, that you can experience higher percentage returns when you get it right, but also a higher percentage loss if you get it wrong. Okay, but the good thing here is that your initial payment is very low, and that you will not lose more than what you have invested, meaning that there is no margin calls. Okay, which leads me to the second reason why investors trade warrants, which is the capital factor. All right, so because of the fact that warrants, they are cheaper in terms of their absolute price compared to the underlying asset, the amount of capital needed for the investors to trade would also be much lower. So one example here is okay, let's take back the previous example, where you have the 1 ringgit mother share and then the 10 cents warrant. The warrant is actually priced at just 10% of the price of the mother share. So in this case, right, instead of buying the underlying shares, you can actually gain leverage, gain exposure to the underlying by buying the call warrant instead, and still profit if the mother share goes up. Okay, so this means that you can increase your exposure while risking a relatively small amount. Okay, and of course, because it only takes up lesser capital, right? Because it takes up lesser capital, it actually frees up share capital for you to diversify your portfolio into other assets or other stocks, meaning you can use the excess capital that you have to buy different financial products on top of these structured warrants. All right. Plus, also with a small capital that that is incurred, right, you also spend much lesser on the commission charges as well as stamp duties as well. Okay. So moving on to the third reason why people trade warrants, I would say, is the fact that they are, investors can actually gain exposure to foreign markets locally. Okay, now because warrants, right, they can be issued over any underlyings that are listed locally or abroad. It actually gives you the exposure to trade the overseas market without leaving Bursa Malaysia. All right, and lastly is, last but not least, is that investors can not only trade the upside in these markets, they can also trade the downside as well, meaning that they are able to profit from both market directions, either up or down. Okay, so these are the four main reasons, if you ask me, why warrants are so popular. All right, now moving on to the next part. What are structured warrants? Now, okay, for the beginners here, one of the more common confusion with many investors, especially beginners, is that they thought there's only one type of structured warrant, which is a call warrant. Okay, now this is actually not the case because there are two different types of structured warrants. There are call warrants and then put warrants. Now, the important thing here to remember about a call warrant is that its value will actually increase when the underlying asset increases. Okay. Whereas for a put warrant, right, it is different. Okay, unlike a call, the value of the put, right, actually increases when the value of the underlying asset drops. Okay, it's the inverse. All right, so this is actually the key difference between call and a put. Okay, so this means, right, for puts, right, they can be a useful tool if you think that a certain stock or index will drop, or if you want to hedge against or profit from that movement. Okay, so these are the key differences between a call and a put. All right, in the next slide, I will show you how you can differentiate from a call warrant from a put warrant, which is very easy, which is just very easy. So all you have to do is to look at the alphabet after the underlying name. So in this case, right, let's say, take for example, this example that you see here. The underlying name here actually is the stock called Hibiscus Petroleum. So the alphabet after the underlying name, you will see a C here, and C actually stands for call warrant. Whereas if you see a H, means it stands for a put warrant. Okay, now don't be mistaken. Do not mistaken the puts with a P, a letter P, because P actually stands for preference shares. All right, now for structured warrants, it's either a C or a H. Okay, and lastly, after the alphabet, you have your warrant series. This warrant series actually is made up of either numbers, digits, or alphabets, or a combination of both. Okay, it's just this is just the warrant series where the exchange uses to differentiate between different warrants in the market. All right, so the key point here to take home is that you can differentiate it by the alphabet after the underlying name, which is here. So it's either a C or H. That's how you differentiate from a call with a put. All right, so moving on to the next slide. Just now we have learned about structured warrants. Now, there's actually another type of warrant in Bursa as well, which are called company warrants. Now, this table, it's good to know. It actually shows you the key differences between them. Now, firstly, we have your structured warrants. There are two different types of structured warrants here. First one is a call, and then there's a put. And then, whereas in this case, I have labeled Genting Malaysia C1I and HSI HM2. This is your call and your put. These are the structured warrants. Whereas as compared to the structured warrants, right, company warrants, we only have one type, which is a call warrant also. And instead, it is labeled as a W after the underlying name. So in this case, I've put Front-End WB as the call warrant here. This is actually a company's call Okay. Now, if you see these warrants, right, they are also issued by two different parties as well. The calls and the puts, the structured warrants, right, they are issued by third-party financial entities like us or other investment banks in Malaysia to be used as a short-term investment tool, while company warrants, they are issued by the company itself in order to raise funds for the future. Okay. And when it comes to expiry, the main differences between the two is that structured warrants, they tend to have shorter tenures, lasting from 6 to 12 months, whereas company warrants can last up to 10 years. All right. And also what investors can do at expiry will also depend on the type of warrant, whether they are cash settled or physically settled. Okay, now, for instance, if you see here, a company warrant, right, is actually physically settled, which means that upon expiry, investors can pay a sum of money to convert their warrant into mother share. Whereas for structured warrants, they are mostly cash settled, which means that if the warrants expires in the money, the issuer will need to pay out to investors either in the form of a check or a bank transfer. Okay, and lastly, right, for the last point, is that company warrants, they usually do not have any market makers. Now, if you are wondering what is a market maker, market maker is actually the entity who provides liquidity to the stock, and is also it provides liquidity to the stock, and it also has control of the price as well. Now, for company warrants, right, there is no designated market maker, which means that nobody has the responsibility to make sure that the warrant has enough bid and ask volume, or that the warrant needs to go up when the mother share goes up. Okay. Whereas for structured warrants, there's actually a designated market maker. Say, for example, for Macquarie, if we issue a warrant like Genting Malaysia C1I, we have the obligation to make markets for this warrant as well. Okay, this is because for investors who want to buy or sell, we need to make sure that this warrant has enough volume for investors to buy and sell back. And also we need to make sure that when the mother share goes up, the warrant needs to track the underlying accordingly as well. Okay, so those are the key differences between the different types of warrants in Malaysia. Okay, it's good to know. Okay, moving on to the next topic, we have the key warrant terms, which I have included. I will explain these key terms here. But as always, if you want to have something to read, or you can also, something to read, something to refer to next time, you can also tune in to our website, which is malaysiawarrants.com.my, under Investor Academy, where you can read up on more details, right? Now, the first item that I would want to talk about is the warrants moneyness, whether in the money, at the money, or out of the money. Now, we can use the warrants exercise price to determine a warrants moneyness. Okay, so the exercise price here is also commonly known as a strike price. This is actually a fixed price in which the investors are entitled to buy or sell the underlying share on the expiry date. Okay, so how we can identify if a warrant is in the money or out of the money is very simple. It is just by comparing the exercise price and the underlying price only. Okay, just these two things that you need. So in this case, let's say take for example a call warrant. The call warrant is actually it will be in the money when the underlying price is above the exercise price. And terbalik, on the opposite side, it is out of the money when the underlying price is below the exercise price. And when both are equal, we are at the money. So vice versa, for put warrants, right, it is the exact opposite. So if you see that the underlying price is above the exercise price, the put warrant is actually out of the money. And when you see the underlying price is below the exercise price, that is in the money for put warrant. And when both are equal, it is at the money. All right, so more examples here that I will show you is this. So this is a real life example whereby you can easily tell whether the call or put is in the money or out of the money. So the same thing here. If let's say if you see a call warrant and it has an exercise price that is lower than the underlying, it means that it is in the money. So this is in the money. Whereas if this is a put, if you notice here, H stands for put. And when put, the exercise price is more than the underlying price, like here more than the underlying price. This put warrant is also in the money. Okay. Vice versa, on the opposite side, this is on the flip side. If you see that the exercise price of a call warrant is very far away, very far above the underlying price, above its underlying price, it is out of the money. Whereas if you see for a put warrant here, it's starting with a H, this is a put warrant. If the exercise price is way below the underlying price, then this is out of the money for a put warrant. Okay, now, I mean, you might be wondering, why am I talking about this? Okay, so actually, which warrants? Many people, they will ask which is better. So is there one that is better than the other, or anything like that? So in this case, it actually depends on the trader's objective, because both have their users. All right. Now, if you compare, right, both in the money or out of the money warrants, the in the money warrants actually have intrinsic value. They have intrinsic value. All right. And because, and also they will be priced higher than compared to out of the money warrants. Okay. And also, because due to the fact that they are priced higher, you will see smaller percentage changes in their price moves. And they are also more sensitive compared to the out of the money warrants. Okay. Now, because of this, right, in the money warrants, there are, many, they are more suitable for short-term or intraday traders who like to jump in and out of the market very fast. Okay, so they would more normally prefer in the money warrants. Okay, now on the other hand, for out of the money warrants, they have no intrinsic value. That's for one, and they are also less expensive compared to in the money warrants. Okay, if you see here, they are also less expensive, and because of the fact that they are less expensive, you will also tend to see big price movements in the out of the money warrants. I mean, it's not uncommon that you can see out of the money warrants gaining by 50 or 75% in a day. This is because of the fact that they are they are less expensive. Okay, and comparing to in the money warrants, right? Out of the money warrants are also less sensitive because they are also less sensitive, and because of the fact that they are relatively cheaper, right? It makes them more desirable to traders with smaller accounts or smaller amounts of capital. Okay, so in just a summary, what I want to say here is that if you want to see the difference between in the money or out of the money warrants, right? It's just a matter of the strike price position relative to the market's to the price of the underlying stock. Okay, that is what we call moneyness. Okay, now moving on to the next one is the sensitivity that I've said just now. Now if you remember just now, I've said earlier that in the money warrants, they tend to be more sensitive. Actually, you can see it here, where we compare these two different warrants, the two different call warrants, C2U and MyAG C2M. C2U is actually more sensitive. Now, why do I say so? Now, if you compare here, right, most of the time sensitivity, we see the exercise ratio. So everything being constant, if a warrant has a lower exercise ratio, it tends to be more sensitive compared to the warrants that has a higher exercise ratio, like what you see in this example. So in this case, right, if you see the sensitivity here, 2.33 versus 5.41, they actually this warrant is a more sensitive warrant, which is MyAG C2U, because the lower, if you see here under this tab here, it shows the sensitivity level. The lower number of ticks, it means that the warrant is more sensitive. Now, after all I have spoken about sensitivity, right? What is actually the sensitivity? Okay. Now, this sensitivity here actually shows you how much that the underlying mother share needs to move for a one tick movement in a warrant. Okay, how much this underlying needs to move for a one tick movement in the warrant. Now, in other words, how many ticks the mother share is required to move just for the warrant to move by one tick. Okay. Now, usually warrant sensitivity is used by short-term day traders or investors that are interested in the small movements in the warrant. So if you're wondering where you can find this tool, right, it's actually called the Live Matrix. It can be found in our webpage under the Live Matrix tab, which I will cover later on. Actually, many other issuers have the warrant sensitivity displayed on their website as well. You can just view it from there. Okay, so back to the example here, what I want to emphasize here is that the sensitivity, you want to determine the sensitivity, right? You can look at it based on the sensitivity tab, and the lower amount will show you that the warrant is more sensitive. Now, in this case here, if you see 2.3 ticks, it means that it takes only 2 to 3 ticks movement in the mother share for the warrant to move by one tick. Whereas if you compare with this C2M, which is 5.41 sensitivity, it takes 5 to 6 ticks movement in the mother share just for the warrant to move by 1 cent. Oh, sorry, one tick. Okay. So that is basically how you can see the sensitivity from the website. All right. Now, moving on is another interesting topic. It's about the structure of a warrant. Now, we in this case, in this slide, right, we talk about the pricing for warrants, which is basically put into two main components. Being one is the intrinsic value, and number two is the time value. Now, this means that the warrant, right, the warrant price is actually the sum of the intrinsic value and its time value. Okay, now let's go through intrinsic value first. Okay, now if for intrinsic value is actually the current value of the warrant, meaning how much in the money it is. Okay, remember when you say earlier, in the money warrants actually has intrinsic value. So this intrinsic value actually tells you how much in the money it is. Okay, when the warrant is in the money, it means that it has a positive payout to the buyer at expiry. So taking this example, right, this call warrant, for example, this call warrant is actually in the money. How you can see the intrinsic value, right, is just to take the difference between the current price of the share minus the exercise price. You divide by the ratio, which is 1. So here you get your intrinsic value as 20 cents. And this value, this intrinsic value actually represents what the buyer would receive if he had held the warrant to expiry. Okay, so in other words, this means that out of the money warrants or even at the money warrants, the holder will not get any payout at expiry since the intrinsic value is 0. Okay, so back to the example here again. Let's say if the stock is trading at 220, for example, 220, and your exercise price is 2 ringgit, your ratio is 1, your intrinsic value is 20 cents. Okay, now the warrant is trading at 30 cents. The remaining value, right, that makes up the warrant's price is the time value. Okay, so time value, I mean, all warrants will have time value, and longer dated warrants will have higher time value as compared to the shorter dated warrants. This means that if you have a warrant that has many months away from its expiry, we can expect a higher time value on it because there is more opportunity for the warrant to increase or decrease in value over the next few months. So if a warrant, let's say if it's expiring in just 3 days, then we can expect its time value to be very little because there's little opportunity for the warrant to increase or decrease in value anymore. All right, now this time value is actually the potential increase in value of the warrant. Sorry, the potential increase of the value that the warrant could gain over time. Yes. Okay. Now, like what you have seen here in the example, right? The time value is actually calculated by subtracting the intrinsic value from the warrant price then you will get the time value. For warrants that are at the money or out of the money, right, the warrants price is totally made up of time value, because like what I said just now, at the money or out of the money, they don't really have any intrinsic value at all. So whatever value that you see, right, it is represented by the time value alone. Okay. And something you want to note here is that this time value, right, it doesn't always stay constant, because warrants, they will lose their time value when the expiry date draws nearer. So this is known as time decay. Okay. Now, so let's just take this example again. If we have this example here, so let's say assuming that this warrant still has 2 months left to expiry, and then you buy it now at 30 cents, and you plan to hold it to expiry. So if the money share doesn't move at all, right, it just stays there at 220 for the rest of the tenure, right? End of the day, at expiry, you will actually only get back 20 cents. This is due to the time decay, because the time value would have been reduced by time decay. Okay, which means, right, if you are the holder of this warrant, and then the mother share, you bought this warrant at 30 cents, and then the mother share doesn't move at all, it just stays the same, you're actually losing money. This is due to this is because of the time decay that I mentioned. Okay, now time decay is sort of like a holding cost of the warrant, whereby the time value portion of the warrant, right, it declines over time, even when the underlying doesn't move at all. It remains constant. Okay, now there's definitely no escape, because all warrants will experience time decay as they have an expiry date. This means that with each day that passes, time decay will cause the value of the warrant to decrease, and the drop in this warrant's value, right, is not linear. If you see here in this chart, it's not linear. It's actually it goes towards the expiry date, is more exponential. So it typically accelerates as the expiry date comes nearer. So meaning, right, warrants that has a longer time to expiry, they generally see a slower rate of decay as compared to warrants that are shorter dated. Because time decay, right, it will also this time decay, you have to take note that it is also present on weekends and public holidays as well, when the market is not trading. All right. So what we normally do is we encourage investors to always avoid expiring warrants due to the rapid time decay that they experience. All right. So moving on to the next one, which is effective gearing. This effective gearing actually measures the rate of change in the warrant price with respect to a 1% change in the underlying asset. So let's say if taking this example, right, if this call warrant has an effective gearing of 8 times, it means that for every 1% movement in the underlying, the price of the call warrant is expected to move by 8%. All right. Now, this effective gearing, it can also help you to decide how much to invest. Okay. Now, take for example, let's say you have a warrant that has effective gearing of 10 times. Let's pretend we have the warrant with 10 times effective gearing. If let's say you buy 10,000 worth of this warrant, right, you will have an effective share exposure of 100,000. So this is actually very useful if let's say if you are holding a certain number of shares and you want to release some share capital, right? Let's say you want to release some share capital and you don't want to lose the stock exposure, you can actually buy. Let's say you have 300,000 worth of shares and you want to release some share capital without losing the stock exposure. You can actually buy 30,000 worth of a warrant with the effective gearing of 10 times, which gives you the same amount of share exposure. At the same time, you get to release some of your share capital. All right. So this is how you can use it to release some share capital. All right. So many people would confuse that the higher effective gearing is better. Actually, this is not the case, because the higher the effective gearing, it means that the warrant will see a bigger movement. The warrant will see a bigger movement but it also comes with a higher profit potential. Okay, higher profit potential and higher risk. So higher effective gearing, higher profit potential, but also at a higher risk. Okay, so it's not necessary that higher effective gearing is good. It only tells you that it moves bigger and giving you a higher profit potential, but it also comes with higher risk. So the important factor here to know that is to know the risk tolerance of that investor. So if let's say if you are not so keen in something that is risky, maybe you can try some warrants that are relatively lower effective gearings, that have relatively lower effective gearings. All right. Now, with the key terms, you might be wondering how or what are the steps that you can take before selecting a warrant. Here, basically, we have put into 4 simple steps on how you can select a warrant to trade. Step 1 being, which is very important, is to have a view of the underlying, to know what is the outlook of the underlying. Is it going to go up or go down? So based on that question, you can choose whether to invest or trade a call or put. All right. So after you have completed that step, you can move on to step number 2, which is to know your time frame. Okay. Now, I forgot something about step number 1. Besides knowing the direction that you want to trade on, right? It is also important to know your target price for the underlying, so that you can plan your the level that you should exit. Okay. Now, after you have decided on step 1, right, you can move on to step 2, which is to decide to know your time frame. So in this case, right, you can also ask yourself, how long do you expect the underlying to move to your target, or maybe how long you plan to hold the warrant for. And then from there, you choose your expiry date based on the trading time frame. Okay, so let's say, for example, if you think that the stock will move to your target price within 2 months, then maybe you can choose a warrant that has 3 or 4 months to expiry, so that it gives yourself some buffer. Okay, now once you have decided on the time frame, you can move on to the effective gearing part, whereby you need to find a right balance between risk or return. So effective gearing here, like what I said just now, it measures the rate of change in the warrant with respect to a 1% change in the underlying. So let's say if take for example, you are a more risk averse investor, you can choose something that has a relatively lower effective gearing level. All right. And after that 3 steps, you move on to the last one, which is to consider the liquidity of the warrant. Now, in this part, right, the liquidity actually determines how easily investors may enter and exit their positions. Okay. Now, I can further explain it in my next slide. I actually dedicated a whole slide on how you can check for the liquidity. Okay, now many investors, right? For many investors, they might think that the liquidity is equal to volume traded. Okay, but this is actually not the case for warrants. Okay, so how you can determine when a warrant has good liquidity is through 2 main points. Okay, the first one is to compare the bid and the offer volume of the warrant. And the second one is to make sure that the warrant is actually on a tight spread. Now, tight spread meaning that the buyer and the seller price for the warrant, right, is actually 1 tick wide only. Okay, which is half a cent for any warrants that are below 1 ringgit. Okay, so for this example, right, let's say you compare warrant A and warrant B. You might notice that this warrant A, it actually has a much heavily traded volume as compared to warrant B. Right? But if you see clearly, warrant A actually has a wide spread. You see there's actually a gap between, and warrant A actually has smaller bid and ask volume as compared to warrant B. Now, if you see warrant B here, it actually has much more bid and ask volume, and it also is on a tight spread. So this is actually a warrant that has good liquidity. Okay, now why would you want to buy? I mean, it's important to buy a warrant that is on a tight spread. Okay, this is because let's say if you buy, let's say if you didn't consider the bid and offer spread for the warrant, and then you bought the warrant at a wide spread, it means that your cost of trading, right, is actually higher already. So which means you in order for you to break even, right, the underlying needs to go up even more just for you to break even. Okay, that is why you should always make sure that the market maker is offering a tight spread. Okay, and how you can do that is by referring to the live metrics, which I will explain in the latest slides. Okay, now those are the 4 steps that you can take to excuse me. Those are the 4 steps that you can take to when choosing a warrant. Okay, there are also other factors that you may want to consider when choosing a warrant. Okay, this includes whether the issuer or the market maker is a reputable one. Okay, and also you might want to consider the warrant sensitivity as well, which I explained earlier. Now, depending on your profile, whether you want to choose a more sensitive warrant or not too sensitive warrant, that actually depends on your goals. So if you're planning to trade intraday, then perhaps, yes, you might want to go for something that is more sensitive, right? Now, also do take note if a warrant is sold out or not, okay? So this is the third point here. Okay, when a warrant is normally listed, right, the issuer must specify an issue size or an amount of inventory to issue. So meaning that the number of warrants that can be sold, right, by the issuer, it will be stated in the term sheets for all the warrants. So if let's say, right, when investors have bought all of the warrants inventory, right, the inventory will be listed as sold out or close to being sold out. So what happens when a warrant is close to being sold out is that the issuer, right, is no longer able to provide a tight spread, and the warrant's offer price will be widened to avoid further buying from investors. Okay, and once the inventory is completely sold out, the issuer, right, they can no longer provide any offer price anymore. Okay, now this means that the live matrix that you will see, that I will explain later, it will display 0 for the offer price. It means that the issuer has no more warrants left to sell. Okay, and only once the issuer has some inventory back, or maybe some other investors have sold back the warrant, only then the offer price will once again appear in the live matrix. Okay, now one thing to note here, right, about this about when a warrant is sold out is Macquarie's bid price will always be maintained, and it will follow the underlying price movements. This is to allow existing investors to sell back at a fair price. Okay, now normally most issuers, they will notify when a warrant is sold out on their websites. Like for us, investors can easily find out if a warrant is sold out or close to being sold out on our website under the warrant announcements, under the sold out section. And also we will post it on our Telegram channel as well. So which means once a warrant is sold out, right, we will be updating it in those channels, so investors can actually see it from there. Okay. That is on sold out warrants. Now, again, the last point is on widespread, which I've explained earlier. I mean, if let's say you might want to avoid trading warrants that are on widespread, because it will increase your cost of trading, and the mother share would need to move even more for you to break even. Okay, so these are the factors that you might need to consider when trading a warrant. All right, now moving on, right, to the next section. This is going to be something interesting that everyone can look out for. Which is the tools that you can use to trade warrants. There are actually many different tools out there available for investors to start with warrants trading. And this section, I will just name a few of them that I think is very helpful and that everyone can consider making use of them. Right now, the first tool here is the warrant heat map that I would like to introduce. This is actually available on our website, and it is developed in collaboration with Trade VSA for everyone to use for free. Okay, now it actually tells you directional directional trends, and also it displays how much, it displays like a score of how bullish or how bearish a certain underlying is. Okay, this is based on Trade VSA's proprietary algorithm, of course. Okay, and with this tool, right, they investors can also interpret the strength of the underlying or underlying trend based on the colors that are available. Okay, and besides that, investors can also quickly filter out the warrants from this tool. What are the warrants associated with us with different underlyings? They can also see the chart, and the chart actually comes with Trade VSA's proprietary indicators. So if you are more of a TA guy, and if let's say you do not have any time in analyzing charts one by one, you can actually go to this tool and you can see the trends at a glance. All right. So this is that was the first tool. The second tool here is the warrant search tool, which I find very important for that investors can use. Most issuers have this tool as well, and this is how our tool look like, and is available on our website for free. This tool actually tells you that I mean, I always use it myself to filter out warrants according to my criteria. So depending on what criteria I want to look at, I will just use this tool to easily filter out. Now, if you remember the previous 4 steps that I mentioned just now, right, you can actually do, you can actually implement the 4 steps here using this tool. Okay, now if you remember, the 4 steps was to get a view, take a view of the underlying. That's step number 1. And then from there, you can move to your time frame. And then from there to the effective gearing level. And then lastly is to compare the liquidity of the warrant. So that 4 steps, you can actually implement it on the warrant search tool. Okay, now those are 2 tools. And the last tool that I want to mention here is, I think I've mentioned many times earlier. This is actually the live matrix tool. Okay, this is actually how the live matrix looks like. Now, I believe other issuers have also have this tool, and this is how Macquarie's live matrix look like. It is actually this page, right, is actually directly connected with Macquarie's market making system, and it indicates where Macquarie's bid and offer prices will be for a warrant based on various points in the underlying stock. Okay, we were the first issuer to come out with this tool back in 2014. So what it does here, right, is that it gives investors a very transparent view of our pricing. Okay, with no registration or login required at all. Okay, so this means that investors, they no longer need to guess where the warrant will trade at when the mother share moves to a certain level. They can straight away see it from this live matrix tool. That's why we strongly recommend that investors, right, to always refer to the live matrix before trading, so that they can check if a warrant is on a wide spread or a tight spread, and plan their trades effectively in advance. Okay, now this is just another view of how the live matrix looks like. I mean, since it's first launching in 2014, we have made massive improvements to the functions and layout. Instead of catering only one live matrix, we can now go up to 9 warrants at a single page. And investors can now quickly check, they can quickly compare the warrant terms between different warrants as well. These warrant terms consist of the sensitivity, things like expiry dates, strike prices, effective gearing, and so on and so forth. Okay, it also comes with all these indicators here. The indicators here, whether or not it is going to expire or not, whether it's sold out or not. So it actually is more convenient for investors now to use the live matrix. Okay. Now, another usage, right, of this live matrix is that it can help you plan your trades in advance. So just because of the fact that you get to know where the warrant will be trading at certain price points in the mother share, right? You can also use it to map up your trading plan. So just like when you are trading your stocks, you should know where your target price will be. for the underlying, so you can plan your exit level in advance. So in this case, right, I've used the HSI futures as an example. So let's say, for example, you have already had your entry and exit price in your head. So based on those price points, right, you already know where the warrant will be trading at. So in advance, you can already queue your order to take profits at your target price. Okay, so this actually helps you plan out your trade in advance, so you don't have to guess anymore. Okay, now here is just one of the examples of how you can plan your take profit. You can also plan your stop loss as well. So let's say risk management is very important when you are trading. So with the help of the live matrix, right, you can also plan your stop loss, because not all trades will work out all the time, right? That's part of the game. So based on the live matrix, you can actually plan your trades. In case, let's say in this case, you want to buy the underlying, you want to buy the warrant at 42 cents when the when the underlying is trading at 20481, for example. So let's say if you want to get out of the market when something is not right, so your last defense would be at 20386. So you already know in advance when your underlying moves to 20386, how much the warrant will be worth. So in this case, it will be worth at 40.5 cents. So it lets you set your stop loss there, so that you get to know where the warrant will be trading at when the underlying moves to that price, that stop loss price. Okay, so this is actually how you can plan for your trades using the live matrix tool. All right. Now, I've mentioned many times about the spread of the warrant just now. Tight spread, meaning that the bid and offer price is just one tick away, like what you see here, one tick away. Now, you can also use the live matrix tool to see whether a warrant is on a tight spread or on a wide spread. Now, in this case here, right, this warrant, the first one, is on a tight spread because the differences between the bid and the offer price is only one tick apart. Okay. Now, compared to that one, this one actually is wide. If you see here, 9 cents versus 11.5 cents. So that is actually on a wide spread. So by referring to the live matrix, it also tells you whether the warrant is on a wide spread or a tight spread. Okay, now in this case, it is on a wide spread because it was close to sold out. So I mean, you don't want to buy into a warrant that is wide, because it will just increase your trading costs. So with this tool, you can actually determine whether it is on a wide or on a tight. So that's why we always recommend our investors to always use this tool before trading the warrants. All right. Okay, now moving on to the interesting part here, which is the technical analysis and case studies. So there are these are just some of the examples of how you can use warrants, or rather make use of warrants to incorporate them into your trading portfolio. All right, now, say for example, because I'm more of a charts person. So say for example, you are a technical trader as well, okay, and you have spotted a potential breakout of a significant resistance area, and you want to gain bullish exposure to this stock. Okay, now of course, if you want to gain bullish exposure here, you can either buy the underlying stock directly at 629 ringgit when it broke out. But if you think that the price of the stock is too high, or maybe you have other plans to use your capital, I mean, you want to use your capital for other purposes, you can actually gain exposure to the stock on this stock P metal on the upside by using call warrants. Okay, so let's pretend that instead of buying the underlying share, you this time you want to buy the call warrants instead. Okay, now if you have noticed here, right, in the period from 7th February to 7th March, in that 1 month period, the underlying stock actually went up by 12.9%, which is very good already, which is very good. Okay, now what's more impressive is the gains for the call warrant. which is more than 56% within the same period of time. Now, this is due to the gearing effect, which what I mentioned is the main attraction for why people trade warrants. Now, this is how you can actually gain leverage exposure via structured warrants, which means that it can serve as an additional tool in your portfolio if you want to gain exposure at a smaller initial capital. Okay, now I have another example here, which is also a breakout. Okay, by the way, if you are interested in knowing how you can catch trending setups or underlines that are trending like this, do let me know in the comment box. I mean, if you're interested, maybe I can share some of the simple ideas that I have so that you can easily use it to analyze the charts. I mean, after I finish my slides, of course. All right, now back to the example here, right? It's the same thing. Instead of ID, call warrant to gain exposure. All right. Now, within the same within that period, right, where from 7 Jan to 9 March, the share actually rose up by a lot, by up to 59.5%. But what's more fascinating here is that the call warrant has actually moved by more than 266% within that same period of time. So this is actually the power of structured warrants. So if let's say if you have, you have any ideas or you have any setups for momentum trades, something that is a very quick or like a breakout that is very impulsive, you can actually take advantage of this by using structured warrants. Okay, now because of course, I mean, if you have been trading for a while, you will have known that markets, they don't always trend up all the time. Now, before this, right, normally when there is a bearish market, what we as investors do is we stay on the sidelines and wait for the market to turn back up. Okay. Now, thanks to the help of structured warrants, those days are long gone, because now we can also hedge against or even profit from a bearish market by buying put warrants. Okay. So this so taking this stock for example, right, which saw a massive sell-off. Let's say instead of sitting on the sidelines and doing nothing and hoping that the market will rebound back to an uptrend, you can actually gain bearish exposure by buying the put warrants. All right. So here is, in this case, let's say you want to gain bearish exposure by buying the put warrants. The same thing. Now, within that period of a few months, right, it actually fell by 40%, which is a lot if you are holding the stock. Okay. Now, if let's say if you want to take advantage on if you have to take advantage on the bearish side, the put warrant actually have gained by a whopping 291%, 291.7% within the same period. So this means that now investors, right, they have more choices to trade already. Not only that, they can trade local or foreign underlyings, they can also trade in both market directions as well, either upside or downside. All right. Now, another example here, if you can see, is the Hansen Futures. This is quite recent as well. I think it's in the beginning of March, where the futures actually plunged by around, I think, more than 20%. Now, investors, right, they don't need to just wait on the sidelines anymore. They can actually speculate on the downside using the put warrants. Okay. Now, and just the same as the previous examples where I shown you, okay, the underlying actually fell by 22%. And the put warrant in the same period of time, this is just 3 weeks, around 3 weeks, the put warrant actually gained by more than 600%. So these are the examples. These are just some of the examples of how investors can use structured warrants as an additional tool in their toolbox to trade, not only on the local or foreign underlyings on the upside, but also on the downside as well. All right. So yeah, I'm done with that. So just want to move on to the next topic here. I just wanted to highlight the new coverage over the our Dow Jones index and the Nasdaq index. So if you have been trading for some time in Bursa, you might have traded or seen the S&P warrants on Bursa Malaysia before. All right. Now we have since added new coverage to other major US indexes as well, which is the Dow and the Nasdaq, so that investors they can further diversify their portfolio too. All right. So here's just another avenue for investors to diversify now. All right. So this the same as the S&P warrants, the new Dow Jones and Nasdaq warrants, they will track the movement in the relevant futures contracts as well. Okay, these futures contracts actually trade 23 hours a day, and they cover the full trading hours of Bursa Malaysia. So investors, right, they can now trade these warrants with their existing CDS account or their trading accounts that is maintained with their existing brokers. All right. So this means that now we have warrants over three main US indexes already available for investors to trade on. And I mean, it's not exactly new. They were first launched in December. And just last month, we have since added more warrants over these names to cater for the demand and the wide market moves. So do take note that if you are keen to trade these warrants over the Dow and the Nasdaq, do keep a lookout for the warrant name DJIA and NDX over in your Bursa trading platform. And the DJIA actually stands for Dow, whereas the NDX is the Nasdaq. Okay, now, okay. So these are the latest. I mean, continuing from my previous slide, these are actually the latest Dow Jones and Nasdaq warrants that are currently listed on Bursa Malaysia. I mean, not currently. This is as at 24th March. If you see the comparison in price changes, right? When the underlying index right rebounded from their recent drop, you could actually see the warrants. I mean, by using warrants, right, the percentage gain and loss is actually very much bigger than compared to their underlyings. Okay, this is due to the gearing effect. Okay, now if you're keen in trading these warrants, do keep an eye for these in your trading platform. And yeah, I think I have pretty much came towards the end of my session here tonight. Okay, now just one more thing before I end this. I just wanted to let everyone know here that we actually have our own Telegram channel where we put continuous updates on structured warrants as well as local and foreign markets news to help with your daily trading and decision making. So do join us on our Telegram channel. I mean, if you have already have a Telegram account, right, you can easily type in Malaysia warrants on the search bar, or you can just scan this QR code on the slide here to directly join the channel. Okay, now if you have missed this, it's okay as well, because if you log into our website at malaysiawarrants.com.my, there is actually a button for you to join the Telegram channel. All right, now these are what we highlight to investors on a daily basis. No, I mean not on a daily basis, on a market open basis. Okay, whenever the market is open, we will highlight to investors. Usually what we highlight are new warrants listing, you know, what are the market movers, what are the trending warrants. We also provide a lot of educational tips for investors on our Telegram channel. For example, warrants expiry calculation, corporate actions, and so on and so forth. Okay, so do follow us on the Telegram channel to get the latest updates. And also, if you are on Facebook, do follow us on Facebook. And the same thing as the Telegram channel, we also post all these updates on our Facebook channel as well. Okay, so do drop us a like and follow us on our Facebook channel. And with that, I think I'm done. I'm passing the floor back to Shane.
Thank you so much, KK. I think there have been quite a number of people who say that super presentation. All right, thank you so much, KK.
Was it?
I think just now you mentioned that if you have time, you want to talk more about how to spot like early breakout, right? Would you want to take a minute to talk about that? I think there have been some people who ask you to share a lot about that.
Okay. Let me just push on to my slides. Sorry, to my charting platform. Just one moment, guys. Let me take out. Can you guys see my screen?
Yes.
All right, good. Okay. I mean, of course, okay, this is the part where it's interesting for me because many clients actually ask this question as well. So there are actually many ways or strategies that you can use to trade warrants. This includes technical analysis or fundamental analysis or even a combination of both. So it all boils down to what works for you because there's no one fixed method to use. Okay. Now, but since I'm not very good with TA, I'm not very good with FA fundamental. I only use technical analysis. Yes, I can. I'm able to show you some tips or give you some ideas on how you can tell trends and stuff like that. Okay, but do bear in mind, right, that for technical analysis, right, there are many different techniques. This is just what I'm going to show you. Is just one of them, and also this is by no means of any financial advice or recommendation to buy or sell. This is just to give you an idea, and it's solely for educational purposes. All right, so okay, for TA wise, just now I mentioned, right, there are many different setups that you could use. Okay, now in my experience, and due to limited time, right, I think I can show you one of the setups, which is simple, and it's actually a trend continuation setup that you can learn. Okay, let me just go straight into the chart. Okay, so okay, what I use here normally is the RSI indicator. Okay, now basically what we want to do here, right, is to have two different RSI indicators in your chart. Now, in my chart, right, if you see at the bottom side of the screen, I actually have two different indicators, RSI indicators. The first one, you would want to, the main important part here, right, is to change your indicator. Because RSI, the default setup, right, is 70 and 30. Okay, so now what we are going to do here is to change our RSI default setup, right, into 60 and 40 instead. So what you see here in my screen, right, the RSI upper band is moved to 60, whereas the lower band is moved to 40. Okay, so that is the first RSI. The second RSI, I do the same as well, 60 and 40 as well. Okay, now that's step number one. Okay, now once you have done that 60 and 40, right, what we want to do here is at just one of the RSI indicators, right, you want to change the time frame to the weekly time frame. Okay, so it's not to say weekly time frame because what this methodology states, right, is that we need two different time frames to trade. Okay, first one being the higher time frame, which is the bigger time frame. The second one being your working time frame, which means the working time frame is the time frame where you enter your when you trade the market. Okay, so two different time frames. Now in this case, right, I have used the bigger time frame. I have used weekly chart. If you see here, I've changed it to weekly. So on the top RSI is actually my weekly RSI. Whereas on the bottom RSI is actually the daily RSI. If you see here, my chart is on the daily time frame, and the bottom one is the daily time frame. Okay, so listen carefully. So after doing that 60-40 thing and changing the weekly, I mean the bigger, the one of the RSI to the weekly time frame. First, I will explain about the bullish setup. Okay, now the first thing I need, right, for a bullish setup is that I want the weekly time frame to be above 60 level. So if you see here, the blue line, the blue indicator, right, is actually my weekly RSI. So I want it to be above 60. So if you can see on this chart, I will mark a level here. So when this blue, I mean, after this blue line, from this point onwards, my chart is actually above RSI 60. Okay, so far so good. So this is actually the the time frame where we can look for potential setups. Okay, this arrow. That means from this blue line onwards, when your RSI is above 60, that is where you can look for potential bullish setups. Now, after confirming this weekly one, right, you can go to your working time frame, which is your daily time frame, and all you need to do is, what I want to see here is to make sure that the RSI is either on the 50 level or 40 level. Okay, 50 or 40 level. So in this chart here, right, if you see here, the middle line here is actually the 50 level RSI. Here is also 50. And here as well is on the 50. So if you notice, every time when the RSI, from this yellow arrow onwards, right, every time when the market moves, when the market is above the weekly RSI 60, and every pullbacks to RSI 50 or 40, your market will also see a pullback. But after that, prices would continue on. You get what I'm trying to say? So if you compare the RSI, right, here you get your RSI 50. That is 1 point. Here, another one, your RSI 50. Okay, and you have another third one here, near 50s. That is where the market has actually pulled back. But after that, market continues in their existing trend. So this means that you have your the reason. The gist of this, right, is to confirm a trend. Because what I find most that is a problem with many investors is that they use RSI. That's for sure. They use RSI, but they use it using the conventional way, which is oversold and overbought, oversold and overbought. So if you notice here, right, whenever the stock gets oversold, right, and then you want to sell, right, the market keeps dragging higher and higher. So on the flip side, right, you can actually use it to trade with the trend instead of against the trend. Because if you trade 70 and 30, you are always trading counter trend. This is a different setup. It is a trend following setup, which shows you continuation pattern. Okay. Now, let me show you a different setup. Maybe we get another stock. What are the stocks that you guys want to see? Maybe okay. Let's say this stock, right? You see here, what I mentioned just now. Your first step is to see your RSI on the weekly. So what you want to do here is to mark when the weekly goes above 60. That is where you want to look for potential setups on your daily time frame. So in this case, this stock, it has broke 60 level on the weekly, starting from this blue line, and from there onwards, right, the stock has moved non-stop. Okay. Now, what we want to do here is to look for potential setups on the daily time frame, whereby the market has pulled back. Okay. And how we do that is to see on the daily time frame, the RSI has reached 50 or 40 levels. So in this case, if you notice here, RSI has reached 50. Here as well, RSI has reached 50. Here 40. Here near 40s. Okay, so if you see here, if I've marked the same areas, right, these are the potential areas that investors can look to trigger a potential setup. So how you want to trigger an entry, it actually depends on you, because different traders, right, that I've met, they have different ways of triggering the entry. You can use your stochastics to trigger an entry. It doesn't matter. You can use Fibonacci as well. You can use moving averages as well. Like, let's say, for example, if the candle crosses above the 8 moving average, you want to initiate. Okay, or sometimes some people, like me, usually we use like a form of breakout, price action breakout. So normally what we do here is, firstly, you determine your RSI on a weekly. If it's above 60, and then whenever RSI pulls back to your 50 or 40 levels, then you can stand by for a potential entry. And you can actually stand by, and whenever it breaks, that is your trigger. So that is actually one of the ideas that you can use. Okay, you can also use VWAP as well. So in my charting software, I can see the VWAP for this retracement. So every time it breaks the VWAP, you can use that as an entry as well. So if let's say for instance this arrow, I want to see how much is the VWAP. The VWAP, your orange line is actually here. So whenever it breaks this arrow, you can actually trigger an entry as well. So if you notice, right, because I use RSI is a momentum indicator. So when momentum indicator it shows you momentum. So when it has momentum, right, that is where you can, it is a good time that you can maybe wish to use or consider to use warrants because momentum and then it's short term. So that is how you can write it, okay? Now, I'm not sure if everyone is clear on this because if you're clear, I can proceed to the bearish side because this is just the bullish side. So if you're clear, I can proceed to the bearish side. Can you please type in if you're clear in the chat box?
Yeah, but we don't have very little time for Q&A. So I think maybe
Okay,
we
okay.
should reserve some other questions for warrant related.
Okay, can. No problem.
Okay, I think thanks for showing us how we can use your strategy to spot trend and also how you can use your strategy to buy on dip on an uptrend. So basically, it's just involved two RSI. The first weekly RSI is to look for trend. The other RSI is to look for how to buy deep on the rally. Am I right?
Yep.
Okay,
Right.
thanks for showing us. So there have been a lot more questions on warrant as well. So let's move to the questions on warrant. The first question is, how do we interpret implied volatility? Can we use that to select warrant?
Yes. Just one moment. The implied volatility, right?
Yeah. Which is one of the Greek symbols, right?
Yes. Correct. So normally, right? If you see implied volatility, so giving other factors constant, right? If you want to use IV to go in or entry, right, for an entry, comparing to many different warrants, right? Because now you are buying a warrant. So ideally, you want to buy a warrant that has a lower implied volatility. So let's say if you're comparing IV and IV for two different warrants, you want to go for something that has a lower IV. So IV actually it stands for it's like a measure of market uncertainty. So it's like a measure of market uncertainty about the future returns of a security. So the more uncertain the returns are, right, the more volatile the security will be. So a high volatility actually means that the price of the security can actually swing dramatically. They can swing very drastically over a short period of time on either direction. So whereas a lower volatility suggests that the security value, right, it doesn't fluctuate that much.
Okay, so basically, if all else constant, always pick the one with implied volatility.
Yep, correct.
How about premium? I think a lot of investors also say that always choose the low premium. Okay, is that a myth or is that a fact there?
Actually, the premium is just like a measure to show you how much the warrant needed, how much the underlying would need to move in order for you to break even. So likely you wouldn't want to use that. Probably you can use effective gearing or the sensitivity as the main driving factor. For premium, likely if you want to use it, it's probably when you decide to keep the warrant to expiry, which we usually don't recommend because it's very risky.
So if you want to keep the warrant until expiry, should we go for low premium?
Okay, yeah, correct. Because if let's say the premium, right, it actually stands for how much the underlying would need to move just for the warrant to equal the break even at expiry. So the lesser it is, then the better.
Okay. The next question is by Kathy. Is it possible to buy put warrant when holding stocks to protect for temporarily drop?
Oh, okay. I think I understand the question. So, okay, let's say this is actually, okay, this actually can be done. It is possible to use a put as a risk management strategy to guard against the loss of owning a stock. This is like what you say a protective put strategy. So in this case, right, if the investors believe that the price of a stock that he is holding will fall in the coming weeks or months, but he's still bullish on the long run, but it's just that the coming weeks or months he feel that it's going to go down, he can actually hedge it using he can hedge the potential losses or potential uncertainty by using put warrants, because these put warrants will actually act like an insurance policy by providing downside protection in a case where the stock actually falls.
Okay, so essentially, this is one of the functions as a put warrant as a hedging tool if you want to protect our portfolio from any bear market.
Right.
Yeah, I think Macquarie also offer quite a number of put warrants, right? Especially on index warrant.
Yes, sir, correct. And also the Hong Kong single stocks as well.
Hong Kong single stock. Ah, okay. All right. Henry would like to ask, what will happen if structured warrants expire?
Okay, so there are two different items here that you need to take note. So usually when you hold the warrant to expiry, right, there's two different scenarios. One, it expires in the money. The other one, it expires out of the money. So when it expires in the money, right, then it means that the warrant actually expires with intrinsic value. So what you're going to get back is a payout from the issuer, which will be sent by a check or a bank transfer. That is in the money. So if let's say you hold the warrant, but it expires already, but it is out of money, then you totally do not get anything in return. There's no payout at all at expiry for out of the money or even at the money warrants. This is because there's no intrinsic value.
Yeah. So it's very important that you don't hold out of the money warrant until expiry, because you will get zero.
Yes, correct.
Yeah, I think a lot of investors, when they want to buy shares, right, they mistaken the the warrant as shares. So some of them hold until it expires and suddenly wonder, how come my stocks disappear from my portfolio?
Yes, correct. You have to always practice caution when trading these warrants.
Okay. So if you expire in the money, that you get paid out. If you expire out of the money, then you get nothing lah. So remember. Okay. The next question is by Bell. Any indicator we can use when trading structured warrants? Or can we? No. First of all, let's address this question. Can we use technical analysis on structured warrants?
Okay. Definitely yes. Definitely yes. You can use either TA or FA as well. It doesn't really matter. So as long as it works for you, then it's good. Right now, I mean, whatever that I needed to suggest just now, the indicator, I think I've suggested earlier, which is the RSI, which I think is simple and powerful as well. So I hope investors, I hope everybody can at least get to learn something new tonight.
But that is on mother share, right? So the question here
mother
is,
share.
yeah. So
So
can we apply the same set of indicators on structured warrants?
yes, correct. You technically, right, we apply it to the mother share, that because the warrant actually tracks the mother share, right, the underlying. So that's why we only need to apply it on the mother share only. Because if you want to trade, you want to apply it on a warrants chart, right? You will see that the chart are actually, because not all warrants are actively traded every day. So the charts are very erratic, and it's so random. The candlesticks are very random. So that's why we use the underlying chart as a base for decision making. That's why the indicators, right, it is plotted on the underlying.
Okay, so it's not on the structured warrants, it's on the underlying mother share. Okay.
Yes.
So
Correct.
you pull out the mother share price chart, then you do all sort of technical indicators that fit your objective or fit your trading plan. Then after that, you look for possible entry. Then you go to the warrants to get your to enter your position. Am I right?
Yes, sir. Correct.
All right. So I think that addressed the question. And also there are people who ask, can you explain more about what do you mean by inventory sold out?
Okay, so normally, right, when we when an issuer issues a warrant, right, there is a fixed amount of inventory that they can sell. So whenever they issue this fixed amount, right, and then whenever this amount gets sold, when many people keeps buying and buying, right, whenever the fixed amount is sold out, that is where we call the warrant is sold out. So when it's sold out, it means the issue, right, they don't have any more warrants to sell anymore. So for Macquarie, is if in the case where the warrants is sold out or close to being sold out, the offer price for the warrant, right, it will be widened to discourage further buying, while the bid price will be maintained at a fair price so that existing investors can still sell back at a fair price. So as and when we fully sold out, the offer price will totally be empty, and only when we buy back, then the offer price will come in back again. So only when other investors sell back to the issuer, right, then they will have the inventory back.
Yeah. So when the inventory is sold out, that means you will alert all of them. So when you get some inventory back, then of course you will put in all the price lah. Huh?
Correct. Yes.
Okay. So when the inventory is sold out, remember the trading of the structured warrant is based on the market force. Okay, not by the bid and offer price offered by the issuer.
Yes.
Yeah, there will still be some volume there, just that it is not by the issuer, it's by the market supply and demand. All right, so thank you so much, KK, for doing this segment for us on this Bursa webinar. So now that we've learned how we can gain exposure to the local and foreign market through the structured warrants listed on Bursa Malaysia. All right, so let me tell you about our next webinar, which is happening on this Friday, titled Sudut Pandang Pelaburan Nilai dalam Saham Patuh Syariah. So on this Friday, we're going to talk about how do we do value investing from the Sharia compliance point of view. Okay, so it's happening on 22nd of April 2022, 8:30 to 10 o'clock. I just given you the registration link. So if you want to learn how do we look at value investing from Sharia compliance stocks, please register for this segment. Given you the registration link. So I hope to see you on this Friday. So thank you everybody for tuning into this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today we are very honored to have the equity derivative sales expert from Macquarie, Mr. Choong Kum Kie, who come to this webinar to share with us your nugget of wisdom when it comes to gaining exposure through structured warrants, which is a leverage product to help us to magnify our gains if we get our direction right, and also if we get the direction wrong, it will also exacerbate our loss as well. So it's a very prudent. We must remain prudent when it comes to trading with structured warrants. So that's why it's important for us to learn more about structured warrants before we blindly trade it. So thank you so much, KK, for sharing with us the idea in trading structured warrants.
Thank you, Chen. Thank you, everyone, for your time.
All right. Have a great rest of the day. Bye, everybody. See you next time.
See you guys.
Yeah, for those of you who is asking how to contact Mr. KK, yes, the email is here. Okay, go to info@malaysiawarrants.com.my. Thank you, everybody.